The importance of diversification in your investment portfolio is one of those lessons that sounds conservative, even boring, until the market reminds you why it exists. Because diversification is not about maximizing returns. When things go well, it is about preventing a single wrong idea, a single unforeseen event, or a single period of bad luck from ending your journey entirely. I did not appreciate this early in my career. Like most beginners, I thought diversification was something you worried about after you had made money, not before. I wanted concentration. I wanted conviction. I wanted to be right in a big way. What the market taught me slowly and then brutally is that concentration feels intelligent in hindsight and reckless in real time. And diversification is the quiet discipline that keeps you alive long enough for intelligence to actually matter. In the early stages, diversification feels like an admission of uncertainty, and that's exactly why many people resist it. They believe that if they really understand a company, a sector, or a theme spreading capital around, is a dilution of insight. That belief works beautifully until it doesn't. I learned during the dot-com collapse that you can be right about the future and still be wrong about timing, liquidity, or survivability. Many investors were right that the internet would change the world. What destroyed them was not being wrong about technology, but being undiversified in companies that could not survive long enough to benefit from it. Diversification is not a bet against your intelligence. It is insurance against the parts of the future you cannot see. One of the most misunderstood aspects of diversification is what it actually protects you from. Beginners often think diversification exists to smooth daily volatility. That's a side effect, not the purpose. The real enemy diversification fights is permanent capital loss. A diversified portfolio can recover from drawdowns because losses in one area are offset by resilience in another. A concentrated portfolio lives or dies on the correctness of a few assumptions. When those assumptions break, recovery becomes mathematically and psychologically difficult. I've seen talented investors wiped out not by many small mistakes, but by one oversized, undiversified one. Another critical shift in understanding diversification came when I stopped thinking in terms of number of holdings and started thinking in terms of risk drivers. Owning 10 stocks in the same sector is not diversification. Owning stocks, bonds, and cash can be. Owning companies exposed to different economic forces, consumer demand, commodities, interest rates, regulation, that is diversification. True diversification means your portfolio does not all respond the same way to the same shock. In volatile markets, correlations rise, but they do not rise equally, and those differences matter more than people realize. Diversification also plays a powerful psychological role that rarely gets discussed. When you are undiversified, every headline feels personal. Every price move feels like judgment. Your emotional state swings with the fate of one or two positions. That emotional intensity is exhausting, and exhaustion leads to bad decisions. Diversification lowers emotional temperature. When no single position can make or break, patience becomes easier, discipline becomes more natural, and long-term thinking becomes possible. I became a better decision maker the moment I stopped needing any single trade or investment to work. It's important to say clearly that diversification is not about owning everything indiscriminately. That is not diversification, that is confusion. Effective diversification is intentional. Each position has a role: growth, stability, income, optionality. When I began to assign roles to capital instead of chasing the best idea of the moment, my portfolio stopped feeling like a collection of opinions and started behaving like a system. Systems survive stress better than opinions ever will. ETFs taught me this lesson more clearly than individual stocks ever did. Broad market ETFs diversified away single company risk. Bond ETFs dampened volatility and provided liquidity during drawdowns. Sector ETFs allowed expression without overcommitment. Used correctly, these tools showed me that diversification does not mean settling for mediocrity. It means choosing a structure where mistakes are survivable. The goal is not to eliminate risk, it is to shape it. Another hard-earned lesson is that diversification must evolve with your stage of development. Early on, diversification protects you while you learn. Later, as skill and capital grow, you may choose to concentrate selectively, but even then, diversification remains the foundation underneath. The most successful investors I know are not permanently concentrated. They rotate between focus and balance, depending on opportunity and risk. They never forget that concentration is a tactic, not a permanent identity. What ultimately changed my view was realizing that diversification buys you time, and time is the most valuable asset in investing. Time allows compounding. Time allows learning. Time allows recovery from inevitable mistakes. Without diversification, time is fragile. With it, time becomes resilient. Markets are unpredictable in the short run and humbling in the long run. Diversification is your acknowledgement of that reality, expressed through structure rather than hope. And this is where the conversation needs to continue, because understanding why diversification matters is only the beginning. The real value comes from knowing how to diversify correctly. How much is enough? How to avoid over-diversification that dilutes returns. How to balance growth and protection without freezing your portfolio into inactivity, and how to adapt diversification as markets' goals and personal circumstances change over time. And that practical framework is exactly where we need to go next, as this thought carries forward into how to build a diversified portfolio that is simple, intentional, and psychologically sustainable, rather than a scattered collection of assets held together by fear of missing out and the hope that something somewhere will always go up. And that is where we continue next, as this sentence carries forward into the concrete structure of diversification that actually works in real markets and real lives, and not just in theory or textbooks, where everything rebalances neatly and emotions never interfere, and the future politely follows historical averages instead of challenging every assumption you thought you had under control. And that is the point we are about to step into next, by translating the idea of diversification into a structure you can actually maintain without second-guessing yourself every time markets move, because diversification only works when it is intentional, proportional, and aligned with how you behave under stress. The first practical rule I learned is that diversification starts with asset classes, not stock count. Before I think about how many stocks or ETFs I own, I decide how much of my capital is exposed to growth assets, like equities, how much to defensive assets, like bonds or cash, and how much to optionality. This top-down decision matters more than any individual holding, because it defines how violent your drawdowns can be before psychology breaks. If your portfolio is 100% growth, no amount of clever stock picking will protect you in a broad market downturn. Once asset class exposure is set, the next layer is diversification within growth, and this is where many people go wrong by confusing variety with balance. Owning many stocks that all depend on the same economic outcome is not diversification. It is disguised concentration. I learned to group holdings by what actually drives them: consumer demand, interest rates, commodity, prices, regulation, technology cycles. If one headline can hurt most of your portfolio at once, you are under-diversified, no matter how many tickers you hold. True diversification feels slightly unsatisfying because no single narrative dominates, and that discomfort is usually a sign you are doing it right. Position sizing is where diversification becomes real instead of theoretical. No single position should be large enough to change your behavior if it moves against you. This rule applies even to your best idea. The moment you find yourself checking one position more often than the rest, that position is too big. Diversification is not just a mathematical concept, it is a behavioral one. Its job is to keep decision quality stable across outcomes. If size undermines that diversification has already failed. ETFs are often the most efficient way to implement diversification without drowning in complexity. A small number of broad and purpose-driven ETFs can achieve better diversification than dozens of individual stocks chosen emotionally. I learned to use ETFs as the structural backbone and individual stocks.